If you have been following my blogs, you would be familiar with my reminder to myself that in the current environment, it is probably not a bad idea to be more defensive as investors. The heightened geopolitical tensions in many parts of the world, sticky inflation, higher for longer interest rates, slowing economic growth and the prospect of economic recession in major economies make for a troubling brew. I have also said that as a retiree investor for income, it really makes more sense for me to be more defensive and seek out capital preservation options, reducing beta or volatility in my portfolio. When interest rates were very low, there were people who would borrow money to invest in real estate investment trusts and thought they were actually investing defensively. Why? An idea in defensive investing is to invest in assets which deliver stable earnings and meaningful dividends, and real estate investment trusts, for the most part, looked like a good fit. However, these investors who were borrowing money to invest in real estate investment trusts were not investing defensively. What they were doing was actually aggressive and would fall in the same class as margin trading and options trading. If interest rates were to rise rapidly, which they did, they could find themselves in a boatload of trouble as the unit prices of real estate investment trusts fall and cost of financing rise. What they were doing had little difference with borrowing money to invest in Alibaba's common stock. If the price of the common stock fall below a certain price, the lenders will come knocking, which happened to some investment gurus. I never want to have to deal with such a possibility, which is the reason for the word bread in eating crusty bread with ink slowly. If you are new to my blog and don't understand, I will leave a link to the relevant blog below. Warren Buffett doesn't think it's smart to use debt to buy stocks. He is not a fan of margin debt or loans used to buy more stocks. He thinks it is like playing a game of Russian roulette, and he doesn't like the idea of gambling for a shot at more money. Now, is defensive investing only good for retirees like AK? I would argue that defensive investing is probably a good idea in varying degrees for people who do not have deep pockets. For regular folks who still need their earned income, capital preservation should have a place in the overall scheme of things. For retirees and people who do not have the ability to stomach big financial losses, their investment portfolio should be more defensive than not. The ability to stomach big financial losses will vary from person to person. How defensive an investment portfolio should have an inverse relationship with the ability to stomach big financial losses, theoretically. The more able a person is able to take big losses, the less defensive his investment portfolio could be, therefore. However, I have often seen people who are able to take big financial losses adopting very aggressive investing ideas. I think they should ask themselves if they liked the idea of living next to an active volcano. Defensive investing is also a good idea for people who are mentally unable to take big financial losses. Losing sleep because you lost a few $1,000s in recent investment? Well, then, you might want to do more defensive investing. How do we do defensive investing? I will not tell anyone what to invest in, but I will say this. As long as we invest with an eye on capital preservation, minimizing the risk of financial losses, we are taking a step towards defensive investing. Promises of astronomical growth and future returns from businesses which are burning cash do not interest defensive investors. Thinking of becoming more defensive in your approach to investing now? If AK can do it, so can you.